If the petrodollar died on a single date, markets would have repriced the world overnight. They didn't, because the real story isn't a contract expiring, it's a system slowly losing exclusivity. The modern attention economy loves clean endings. A date, a signature, a switch flipped. That's why the viral version of the story spread so easily, an alleged U.S. Saudi petrodollar pact, neatly packaged as a 50-year contract that supposedly ran out and wasn't renewed. But the closer the claim is examined, the less it resembles an enforceable rule and the more it resembles narrative shorthand. Fact-checking outlets have noted that the 50-year expiry framing is not supported the way it's presented online, and experts cited in those checks say they're not aware of a formal agreement that legally forces Saudi oil sales to be denominated only in dollars. AFP fact-check. PolitiFact. That mismatch between the drama of the headline and the mundanity of the paperwork matters for one reason. It determines whether the audience is analyzing institutions or merely consuming symbols. A reserve and settlement ecosystem doesn't live or die because a talking point goes viral. It lives or dies based on repeated decisions by central banks, commercial banks, commodity traders, and corporate treasurers, decisions shaped by liquidity, legal certainty, operational reliability, and political risk. A system like that doesn't end with a deadline. It erodes when exclusivity erodes. What the shorthand is trying to capture, imperfectly, is the long arc that began decades earlier. After the post-war system tied currencies to the dollar and the dollar to gold, that architecture loosened, and the world moved into a fiat era where credibility shifted from metal convertibility to institutional power and market depth. In that environment, oil became one of the most important conduits through which dollars circulated globally because energy trade is universal, continuous, and large. When oil exporters receive dollars for energy, the story doesn't stop at the invoice. The next step is the one most people skip: what happens to those receipts? This is where it helps to use the cleanest definition available. The IMF describes petrodollar recycling as the process in which oil exporters use some of their oil revenues to buy imports and invest the remainder in foreign assets, bank deposits, bonds, equities, and other claims. In other words, petrodollars are not a law, they are a flow. Recycling is not a conspiracy, it is balance sheet behavior. Once those flows exist at scale, they do two things at the same time. They finance trade in the short run, and they feed back into the demand for the financial instruments, markets, and institutions where those revenues are parked in the long run. IMF. This is why a single-date obituary is the wrong frame. Even if more trades at the margin are invoiced, settled, or netted in non-dollar currencies, the deeper question is whether that marginal change becomes durable enough to weaken monopoly conditions. Exclusivity is the key word. A currency can remain dominant while losing exclusivity. A system can remain central while no longer being the only road. And, historically, the moment a second road becomes credible is when bargaining power begins to move even before market shares fully follow. The petrodollar died meme also confuses what kind of shift people are actually watching for. There are at least three different layers in play. The currency that central banks hold as reserves, the currency that gets used for payments in the global messaging ecosystem, and the rails that move value across borders, whether correspondent banking, tokenized ledgers, or multi-institution settlement systems. Those layers influence one another, but they do not move in lockstep. A headline about oil settlement can be emotionally satisfying while still being analytically incomplete. So what is genuinely changing if not a contract? The practical change is the incentive to build optionality. When the world believes access can be constrained, whether by policy, compliance rules, or geopolitical rupture, then dependence stops being a neutral efficiency choice and becomes a risk exposure. Once dependence is treated as exposure, institutions hedge it the way they hedge any exposure, with redundancy. They don't need to announce a revolution. They just need a fallback that works. The moment fallback pathways exist, exclusivity weakens, and the system that once felt permanent begins to look conditional. That is the story this series is actually telling. Not a free ride ends forever, but the gradual transformation of a monopoly into a market with alternatives. The opening move is to refuse the false comfort of a date and insist on mechanisms. The rest of the analysis follows from that discipline. If exclusivity is eroding, the next questions are mechanical and measurable. What holds the center in place, and what would force the center to share it? So, if it wasn't a single expiring pact, what actually keeps the dollar dominant, and what would have to change for that dominance to weaken meaningfully? The analysis now turns to liquidity, network effects, and the global collateral machine. Reserve currency dominance isn't a trophy. It's a network effect so large that even competitors end up using it because it's where liquidity and safety concentrate. Once the analysis moves past the temptation to treat global finance like a single agreement with an expiration date, the real architecture comes into view. Dominance is built first through institutional design, then reinforced through market habits that become expensive to break. That architecture is easier to see by stepping back to the post-war settlement that standardized trust. The gold convertibility anchor. Gold convertibility price, $35 per troy ounce, 1,944, 1,971 U.S. State Department Office of the Historian, Federal Reserve History was not merely a number. It was a credibility mechanism that made the dollar the reference point for a fixed-rate world. U.S. State Department Office of the Historian, Federal Reserve History. That system failed for reasons that were structural rather than ceremonial. When the United States ended dollar-gold convertibility, it marked the transition from a regime where credibility was partly outsourced to a commodity to one where credibility would be earned through institutions, liquidity, and the ability to supply safe assets. Gold window closure, August 1971 Bretton Woods convertibility, suspended Federal Reserve History, U.S. State Department Office of the Historian. The step that followed, the move toward generalized floating exchange rates, completed the shift into a world where the dollar could remain central without being redeemable for gold, because the network around it was already thick. Federal Reserve History, U.S. State Department Office of the Historian. In that new environment, energy trade mattered, but not in the simplistic way the oil invoice myth suggests. Oil is large, continuous, and globally distributed. It creates persistent cross-border flows. The overlooked part is what happens after the sale. Oil receipts are not stored in vaults, they are allocated. Petrodollar recycling mechanism. Oil exporters spend some revenues on imports and invest the remainder in foreign assets 1,970 seconds onward, IMF. That behavior channels surplus revenue into liquid global assets and funding markets, reinforcing the gravity of the ecosystem where those assets are most plentiful and easiest to trade. IMF. That is the first key point for a global audience. The dollar's role is less about a single commodity and more about the market infrastructure that can absorb the world's savings at scale. The second key point is that the infrastructure becomes self-reinforcing. Every additional user makes the system easier to use and cheaper to hedge. The cleanest snapshot of that network effect shows up in foreign exchange. USD share of FX trades on one side of all trades, 88% April 2022 BIS Triennial Central Bank Survey. This does not mean every trade is in dollars in the naive sense. It means the dollar is the most common bridge asset, the default intermediary that reduces friction when two parties do not want to hold each other's currency risk. BIS. That bridge function matters because it turns the dollar into the cheapest hedge, not necessarily the most loved symbol. A corporate treasurer in Asia can dislike Washington's politics and still choose the dollar for operational reasons. Hedging is cheaper, counterparties are deeper, settlement conventions are standardized, and the legal and contractual ecosystem is familiar. Those choices are not ideological endorsements. They are the economic consequences of network concentration. The same discipline is needed when interpreting reserve data. USD share of allocated FX reserves 57.8%. End 2024 IMF COFR, reported by Reuters. USD share of allocated FX reserves 57.7% Q1 2025 IMF. COFR, reported by Reuters. These numbers point to gradual diversification, but they also need a caveat that prevents overreading. Changes in exchange rates can shift the reported shares even when central banks do not trade much, because non-dollar assets can decline in dollar terms when the dollar strengthens. Valuation effect on reserve shares material and 2024 context. Reuters interpretation of IMF COFR. Reuters, IMF COFR. This is why serious analysis separates the story into layers rather than compressing everything into one claim. Reserve layer central bank balance sheets, COFR EMF. Payments layer global payment messages, settlement currency shares, SWIFT reporting SWIFT. Rails layer the infrastructure that moves value, correspondent banking, tokenization, wholesale settlement experiments, BIS innovation projects, and official releases, BIS central banks. Each layer influences the others, but they do not move at the same speed. A new rail can reduce friction long before it changes reserve composition. A payment share can rise in a corridor without turning into a reserve asset. A reserve share can decline slowly while the dollar remains the dominant hedge in FX. Framed this way, the question becomes less dramatic and more useful. What would have to change for the dollar's network to weaken meaningfully? Not more oil trades in other currencies, but sustained shifts in the conditions that keep the network cheap to use. 1. Deep hedging markets. 2. Abundant safe collateral. 3. Reliable legal enforceability. 4. Operational compatibility across jurisdictions. And 5. Confidence that access will remain predictable under stress. When those conditions hold, dominance persists, even as margins diversify. When those conditions are challenged, especially the predictability of access, actors begin to spend money on redundancy. For the audience trying to prepare for the long run, the most important implication is psychological. Dominance is not maintained by belief alone, and it isn't broken by belief alone either. It is maintained by repeated micro-decisions that make the system cheaper than the alternatives, and it is weakened when those micro-decisions begin to price in risks that the system itself creates. That is the pivot from myth to mechanism, and it sets up the next analytical move. If dominance is a network, then power is exercised at the choke points of the network. If dominance is a network, then power can be weaponized through access payments, clearing, and settlement. This is where countries begin pricing access risk, and why redundancy becomes strategy. The most powerful feature of the dollar system is also its most destabilizing: the ability to grant or deny access. Once that risk is priced in, building alternatives stops being politics and becomes insurance. After the headline fog clears, the machinery that actually moves money comes into focus. Global trade and finance do not run on a single currency label so much as a sequence of permissions: which banks can open correspondent accounts, which payments can be cleared, which securities can be settled, which institutions can touch which markets without triggering compliance alarms. In calm periods, those permissions feel invisible like air. In stress periods, they become the center of gravity, because access is not evenly distributed. It is mediated by choke points, key clearing jurisdictions, dominant correspondent networks, and rulebooks that can be tightened when geopolitics hardens. That is the hinge between dominance and fragility. A system that is broadly trusted becomes the cheapest route for most transactions, but the same centrality also concentrates leverage. When leverage is used through sanctions regimes, restrictions, de-risking pressure, or the implicit threat of exclusion, market participants learn a new lesson. Reliance is not just a cost optimization problem, it is an exposure. Once reliance is modeled as exposure, the logical response is hedging, and hedging in this context means building redundancy. The most important nuance is that the backfire does not require the targeted country to become the architect of alternatives. The backfire happens when third parties, banks, corporates, central banks in non-aligned or swing jurisdictions decide that the probability of losing access is no longer negligible. They do not need to believe exclusion is likely tomorrow. They only need to believe the downside is large enough to justify paying an insurance premium today. That premium can be paid in many forms: additional settlement routes, additional currency lines, additional custodians, additional messaging, and liquidity arrangements. The dollar's role can remain dominant and still be measurably less exclusive. This is why it is useful to separate holding from using. A central bank can keep most reserves in dollars while encouraging certain trade corridors to settle in other currencies. A corporate treasurer can invoice in dollars while diversifying operational settlement options and short-term liquidity facilities. These are not contradictions. They are rational portfolio choices under uncertainty. The system's power is felt most acutely at the moment of settlement, when a payment must clear, a security must deliver, or a bank must prove compliance, not at the moment of rhetoric. Even the institutions at the center of the system implicitly acknowledge this constraint. When official sector innovation projects emphasize that new payment infrastructure must operate within sanctions and governance frameworks, it sends a clear signal: any credible rail must be compliant by design, not compliant as an afterthought. Reuters reported that the BIS stepped back from the M-Bridge project while noting the platform remained years away from being operational and should not be seen as a sanctions bypass tool. That statement is not merely a public relations footnote. It reveals the core trade-off facing alternative rails. To scale, they need legitimacy. To gain legitimacy, they must satisfy the same compliance expectations that make the existing system powerful. The result is a world where alternatives are built not as outlaw highways, but as parallel routes that can survive political weather. Meanwhile, change often appears first in the payments layer, because payments can diversify faster than reserves. A reserve asset must be safe, liquid at scale, and deployable in crises. That is a high bar. A payment currency, by contrast, can grow through corridor-by-corridor adoption as long as counterparties accept it and hedging tools exist. SWIFT RMB payments share 2.88% of global payments by value. June 2025 SWIFT RMB tracker. On its own, that number is not a revolution, it is a footprint. But as a footprint, it matters because it indicates the direction of travel, incremental adoption in the layer where institutions experiment first. The same logic explains why the story should be told as insurance rather than ideology. When access becomes a strategic variable, redundancy stops being a political statement and becomes a procurement decision. Banks evaluate whether a corridor can be settled if one channel narrows. Corporates evaluate whether they can continue to pay suppliers if a currency becomes expensive to hedge or a correspondent relationship becomes unreliable. Policymakers evaluate whether dependence creates a strategic asymmetry that can be exploited. None of these decisions requires a grand announcement. They require a spreadsheet, a risk committee, and a mandate to reduce single points of failure. This is also where the transition from myth to measurable reality becomes unavoidable. If the question is, did the petrodollar die? The answer is destined to be theatrical and misleading. If the question is, did access risk rise enough to fund redundancy? The answer can be observed in institutional behavior, which corridors are being redesigned, which pilots are being moved closer to usable infrastructure, which standards projects are being staffed and financed, and which compliance constraints are being engineered into new rails from the start. The system's dominance still benefits from its own depth, but depth is not the same thing as invulnerability. The deeper the network, the more valuable access becomes and the more expensive it is, politically and financially, to rely on a single path. That is the paradox at the center of modern monetary power. The mechanisms that make the system efficient are also the mechanisms that, when used coercively, create the strongest incentives to build alternatives. What does redundancy look like when it becomes real infrastructure, rather than talk pilots that reach MVP, corridors that settle in local currencies, and rails that compete on cost and speed? The story turns when alternatives move from theory into transaction. Systems don't lose power when people complain about them. They lose power when someone can actually run the transaction legally, reliably, and at scale. When redundancy moves from a risk memo into live infrastructure, the conversation changes. It stops being about whether one currency is good or bad and becomes a question of operations. Can value move across borders without relying on a single set of intermediaries, a single conversion path, or a single legal jurisdiction that can become a bottleneck under stress? In practice, that shift is visible the moment pilots are no longer confined to demonstrations and start producing repeatable settlement flows under a defined governance framework. That is why the milestone language matters. Minimum viable product is not marketing fluff in this context. It is a boundary line between experimentation and something that can be integrated into real workflows. A concept can impress in a lab and still fail in production because banks, regulators, and corporates do not adopt ideas, they adopt procedures. Adoption requires rules for participation, clarity on liability, dispute handling, compliance expectations, and integration with treasury, accounting, and risk systems that already run the world's balance sheets. In June 2024, Project Enbridge described reaching an MVP stage, explicitly framed as expanding the framework that would allow additional monetary authorities and commercial banks to participate in real value settlement activity. The design logic is straightforward. Reduce the chain risk created by multi-step correspondent routing by enabling a shared settlement environment where cross-border transfers can be completed with fewer hops, fewer points of reconciliation, and clearer finality. Even without grand claims about replacing anything, the practical implication is that a new route exists in principle, one that could, over time, reduce the cost of running certain corridors through the legacy stack. But there is a second pathway that is less glamorous and often more immediately relevant: corridor-by-corridor settlement in local currencies. If Enbridge represents a systems-level redesign, local currency corridors represent institutional nudges that change behavior without requiring the entire world to agree on a new standard first. In August 2024, the Reserve Bank of India encouraged banks engaged with the United Arab Emirates to settle at least part of trade payments directly in rupees and dirhams and to report usage. The mechanism here is not symbolic. It is about eliminating an unnecessary intermediate step. When two parties ultimately want INR and AED exposure, routing through an intermediary currency can add conversion spreads, operational delays, and dependence on liquidity conditions in markets that may tighten during shocks. This is the point where de-dollarization as a slogan becomes less useful than route optimization as an operational goal. For a bank treasury desk, the question is not whether a system is ideologically attractive. It is whether settlement can be executed more efficiently with manageable risk. Direct INR-AED settlement is, at its core, a bet that a corridor can be made liquid enough to stand on its own. If enough volume migrates, dealers deepen the market, hedging tools improve, pricing tightens, and what began as a cautious experiment becomes a routine option. If volume does not materialize, it stays a niche. Either outcome is informative because it reveals whether the corridor can develop the liquidity that network effects demand. This is also where the three layers distinction becomes operational rather than academic. A local currency corridor can expand in the payments and settlement layer without forcing an immediate change in the reserve layer. A corporate can pay invoices in AED while still holding working capital buffers in dollars. A central bank can continue to hold dollar-heavy reserves while facilitating bilateral trade settlement in local currencies to reduce friction and diversify operational pathways. These behaviors are not contradictions, they are risk management under constraints. Reserves prioritize safety and depth under crisis. Payments prioritize speed, cost, and reliability for day-to-day commerce. Rails determine which options are available when conditions tighten. The hard part, often skipped in headline narratives, is what scale actually requires. Scale is not a press release. Scale is liquidity, and liquidity is expensive to build. A corridor cannot mature without market makers willing to quote tight spreads, without counterparties willing to hold the currency exposure long enough to settle, and without risk systems comfortable with the legal and operational environment. These are solvable problems, but they are not solved by enthusiasm. They are solved by incentives, repeat usage, and the slow accumulation of trust in processes. That is why institutional behavior matters more than declarations. When central banks and regulators create frameworks that allow commercial participation, they are signaling that optionality is not merely theoretical. When a monetary authority nudges banks to develop direct settlement and asks for reporting, it is quietly building a feedback loop. Usage begets liquidity. Liquidity lowers costs. Lower costs beget usage. The dynamic is incremental, but once it crosses a threshold, it can become self-reinforcing because the route that is cheapest and most reliable becomes the route that is chosen by default. The twist is that this is exactly how asymmetric players regain leverage. A system that once felt unavoidable remains dominant, but it becomes less coercive as soon as credible alternatives exist for specific corridors and use cases. The weaker side does not need to win a global contest. It only needs to remove the assumption that there is no alternative in the moments that matter: settlement deadlines, funding squeezes, compliance shocks, and geopolitical stress. Optionality itself becomes bargaining power. But which strategy wins? Building a parallel highway, M-Bridge, or upgrading the existing freeway so it remains the default? The analysis now puts M-Bridge next to Agora and shows why the coming battle is a standards war, not a currency war. A new monetary order won't be declared at a summit. It will be implemented in code, compliance frameworks, and settlement conventions that banks adopt because they have to. Once a second route becomes plausible, the battleground shifts from rhetoric to standards. The decisive question is no longer who will replace whom, but which workflow becomes the default. Defaults are not chosen in speeches. They are chosen in back offices by payment operations teams, risk committees, auditors, and regulators, because a given pathway is the easiest to justify, the easiest to reconcile, and the hardest to break under stress. One strategy tries to keep the system coherent by modernizing the dominant plumbing rather than escaping it. In 2024, the BIS Innovation Hub launched Project Agora with the Institute of International Finance and a group of 7 central banks, explicitly testing whether tokenization could improve cross-border payments and the broader functioning of the monetary system. Project Launch 2024 BIS Innovation Hub plus 2 IIF plus 7 central banks objective: tokenization experiments for cross-border payments. The logic is pragmatic. If claims on money and settlement assets can be represented as interoperable digital tokens inside a governed environment, then delivery versus payment can become more automatic, reconciliation can become cheaper, and settlement can become faster without forcing every participant to abandon existing legal and supervisory expectations. In plain terms, it is an attempt to make the current ecosystem behave like a modern network while keeping it coherent and auditable. A competing strategy prioritizes redundancy over coherence. Instead of upgrading the incumbent workflow, it bets that parallel settlement routes are the only reliable hedge against access risk and operational choke points. The appeal is not that these routes guarantee replacement, but that they reduce single point of failure exposure. For a corporate treasurer, redundancy means the ability to keep paying suppliers if one corridor becomes expensive to hedge or a key intermediary relationship is de-risked. For a bank, redundancy means not being forced to route every cross-border obligation through the same chain of counterparties, time zones, and settlement conventions. For policymakers, redundancy means decreasing the asymmetry created when a single pathway becomes the global default for clearing and settlement. Both strategies collide with the same constraint: coordination. Cross-border payments sit at the intersection of identity rules, AML, KYC expectations, data localization laws, privacy norms, and legal definitions of settlement finality. A new rail can be technically elegant and still fail if supervisors cannot audit it, if liability is unclear when something goes wrong, or if compliance obligations become more complex than the legacy process it was meant to improve. An upgrade path can also stall if adoption requires too many institutions to change processes simultaneously, because the value of a standard rises only after enough participants use it. In other words, interoperability is not a feature you announce, it is a political, legal, and operational bargain you earn. This is where efficiency is never the whole story. A pilot can demonstrate speed in a controlled environment and still be fragile in production, because the real-world workload includes disputes, exceptions, failed payments, sanctions screening, fraud controls, and governance escalation paths. The more a pathway matters, the more it must withstand worst-case scenarios, not just average-case throughput. That is why compliance by design becomes a gatekeeper. Any system that cannot satisfy auditability and supervisory comfort will remain niche, even if it is technically superior. A realism anchor keeps the analysis from drifting into tech utopianism. The G20 and the Financial Stability Board have worked for years on a roadmap to improve cross-border payments with targets aimed at 2027 lower costs, faster speeds, better transparency, and broader access. Target year 2027 G20 FSB Cross-Border Payments Roadmap. Reuters reported in 2025 that the FSB assessed those targets were likely to be missed, underscoring how slowly global finance changes when infrastructure is fragmented, incentives are misaligned, and legacy systems are expensive to replace. FSB assessment targets likely missed reported 2025 Reuters summary of FSB progress. That single observation explains a lot. Reform is widely desired, but implementation is brutally hard at global scale. The deeper implication is that the future may not look like a single replacement. It may look like stratification. Modernization efforts can keep the incumbent stack dominant in major hubs because they reinforce coherence and supervisory comfort. Redundancy efforts can grow where they solve specific frictions. FX conversion spreads, settlement delays, trapped liquidity, or elevated access risk without requiring the entire world to adopt one new standard at once. Over time, the system can become multipolar in function even if it is not multipolar in symbolism, different routes becoming normal for different use cases, and default becoming conditional on corridor, counterparty, and risk environment. In that environment, the true contest is about rule setting. Whoever defines interoperable standards for identity, messaging, compliance attestations, audit trails, and finality will shape what becomes cheap to use at scale. And what becomes cheap to use at scale becomes the default. So, how do we know which path is winning before the headlines catch up? The closing section builds the dashboard: reserves, payments, shares, rail milestones, and the slow KPI reality that determines whether multipolarity is cosmetic or structural. The petrodollar didn't die. What's dying is the assumption that the world has no choice. The cleanest way to end the noise is to measure what is actually shifting and to admit what is not. On the reserves layer, the United States dollar still sits at the center of the system. United States dollar share of allocated official foreign exchange reserves, 57.8% the end of 2024, International Monetary Fund, currency composition of official foreign exchange reserves, as reported by Reuters. United States dollar share of allocated official foreign exchange reserves, 57.7% the first quarter of 2025, International Monetary Fund, currency composition of official foreign exchange reserves, as reported by Reuters. Those figures do not describe a sudden overthrow. They describe a large incumbent whose margin of exclusivity is being tested in slow motion, while valuation effects and exchange rate swings can still move headline shares even when official portfolios barely change. On the market function layer, the mode is even more obvious. United States dollar share on one side of all foreign exchange trades, 88% April 2022, Bank for International Settlements Triennial Central Bank Survey. This is why settling a trade in another unit can coexist with a world where hedging, funding, and collateral conventions still orbit the United States dollar. Dominance is not just who issues invoices. It is who provides the cheapest bridge when everyone else wants to shed risk quickly. Where motion is easiest to spot is in usage patterns that do not require reserve scale trust. Renminbi, share of global payments by value 2.88% June 2025. Society for Worldwide Interbank Financial Telecommunication Renminbi Tracker. That number is not a replacement story, it is an adoption footprint. It signals that, in certain corridors and under certain counterparties, institutions are willing to add a second or third route, especially when that route reduces conversion steps, lowers operational friction, or hedges against access uncertainty. Infrastructure milestones matter because they convert intent into capability. mBridge Minimum Viable Product Milestone, the 5th of June 2024, Bank for International Settlements Innovation Hub, and participating monetary authorities. Bank for International Settlements, stepping back from mBridge participation the 31st of October 2024. Bank for International Settlements statement as reported by Reuters. Reserve Bank of India encouragement for direct settlement between the Indian rupee and the United Arab Emirates dirham, with usage reporting the 16th of August 2024, Reuters reporting. None of these items proves a new hegemon. Together, they prove something subtler. Optionality is being engineered, and that engineering has institutional sponsorship, legal framing, and operational constraints built into the design rather than stapled on after the fact. That leads to the only responsible way to frame what comes ahead. Conditional scenarios, not countdowns. One path is slow drift. The United States dollar remains the primary reserve and funding currency, but its share inches down as more countries build corridor-specific settlement habits and diversify marginally at the edges. The system becomes less singular, while still anchored by the deepest pool of safe assets and the cheapest hedging markets. A second path is functional multipolarity. Different layers fragment at different speeds. Reserves stay sticky, payments diversify in select corridors, and new rails compete on speed, transparency, and cost. In this world, no single unit wins, but monopoly power erodes because the default route depends on context, counterparty, corridor, compliance posture, and stress level. A third path is shock-driven repricing. A crisis financial, geopolitical, or policy forces institutions to discover, in real time, whether their redundancy plans work. If they do, migration accelerates. If they do not, the incumbent reasserts itself, but at the price of even stronger incentives to keep building alternatives. Shocks do not guarantee replacement. They accelerate learning. For anyone trying to stay grounded, the best tool is a dashboard that separates layers. Watch reserves International Monetary Fund, currency composition of official foreign exchange, reserves shares, and the valuation caveats that go with them. Watch network effects, Bank for International Settlements, foreign exchange turnover statistics. Watch payments usage, Society for Worldwide Interbank Financial Telecommunication Currency Shares, read as footprint rather than prophecy. Watch rails, whether pilots mature into production-grade governance, and whether corridor settlement becomes routine rather than exceptional. And watch the meta-signal, whether institutions treat optionality as a permanent line item because when optionality becomes normal, exclusivity stops being assumed. The core lesson is not that every dominant system collapses on schedule. It is that dominance, once used as leverage, creates incentives for engineering around it. If we want a durable forecast, the safest bet is not on a single replacement, but on the steady construction of choice and on the power shift that choice quietly produces. The coming decade won't be about a single replacement currency. It will be about which rails become default in which corridors, and whether the system evolves through reform, fragmentation, or shock. What began as a viral obituary for the petrodollar resolves into a quieter, more consequential reality. Exclusivity is eroding as alternative rails and corridor-by-corridor settlement options move from theory into practice. History shows that when a dominant financial system weaponizes its privileges, it does not just punish rivals, it teaches everyone else to price access, risk, fund redundancy, and build substitutes that gradually weaken the monopoly. The pattern is familiar. Britain learned after the First World War that financial leverage can accelerate the search for alternatives, and the same incentive logic now pushes the world toward a more multipolar functionality, even without a single replacement currency. If we want a practical edge, we should watch the plumbing reserves, payment usage, and settlement rails, because shifts in infrastructure usually arrive before the headlines do. In the long run, the easiest trend to remember is this. Every time financial power is used as a weapon, it eventually creates the tools that make that weapon less effective.